The Millionaire Next Door. A story written in bricks and mortar. Walk down any street in any city, and you are likely passing by a millionaire. They may not drive a fancy car or wear expensive clothes. Their wealth is not always visible. It is often hidden in plain sight, locked away in the very foundation of the house they live in. In recent years, a quiet revolution has taken place. Millions of ordinary people have crossed the seven-figure threshold. This financial transformation was not driven by stock market miracles. For a great many, the path to becoming a millionaire was paved with bricks and mortar. Real estate, the oldest and most tangible asset class, has been a powerful engine of wealth creation for this generation. The story is compelling because it feels achievable. You do not need a revolutionary tech idea or a degree from an Ivy League school. The narrative suggests that with discipline, a bit of knowledge, and a long-term perspective, anyone can build substantial wealth through property. We see it in our own communities. The neighbor who bought a modest home decades ago now sits on a small fortune. The friend who purchased a duplex and rented out one side now has a steady stream of passive income. These are not tales of high-flying financiers. They are stories of everyday people who understood the power of owning a piece of the earth. This powerful narrative has captured the public imagination. It has fueled television shows, countless books and seminars promising financial freedom through property. The dream is simple. Buy a home, wait for its value to grow. The famous 90% claim. Truth or tall tale? You have probably heard the statistic before. It is repeated in investment seminars, quoted in financial articles, and shared enthusiastically on social media. The claim is bold and simple. 90% of all millionaires become so through owning real estate. This single sentence has become a cornerstone of the argument for property investment. It suggests an almost guaranteed path to wealth, a well-trodden road that the vast majority of successful people have followed. This powerful statement implies that if you want to join the ranks of the wealthy, your first and most important step should be to buy property. The idea has been promoted by influential figures and organizations for years. The National Association of Realtors in the United States, for example, has published reports showing the immense wealth held in real estate by homeowners. Their data consistently highlights that a homeowner's net worth is multiples higher than that of a renter, often more than 40 times greater. Such figures powerfully reinforce the idea that owning property is the key differentiator between the wealthy and everyone else. This message resonates because it aligns with the traditional dream of home ownership. It transforms a home from just a place to live into the primary vehicle for financial security and upward mobility, making the act of buying a house seem like the most important financial decision one can ever make. This appealing notion paints real estate as a uniquely reliable wealth-building tool. People see their parents' homes, grandparents' homes, purchased for a modest sum decades ago, now worth a fortune. Peeling back the layers, a counter-analysis of wealth creation. However, like many popular sayings, the 90% claim starts to fray when you examine it closely. A growing number of financial analysts and experts argue that the statement is, at best, a gross oversimplification and, at worst, a misleading myth. The core of the counter-argument is about correlation versus causation. Does real estate create millionaires from scratch, or do people who are already on the path to becoming millionaires simply use real estate to store and grow their existing wealth? The distinction is critical. If the latter is true, then real estate is not the origin of wealth, but an amplifier of it. Analysts from institutions like NASDAQ have directly challenged the myth. They point out that a vast majority of millionaires, according to studies like The Millionaire Next Door, built their initial fortunes through other means. The most common paths are owning a successful business, climbing to a high-paying executive position in a corporation, excelling in a lucrative profession like medicine or law. These individuals first generated significant income and savings. Only after accumulating this initial capital did they turn to real estate as a safe, tangible place to park and multiply their money. For them, property was not the engine of wealth, but the garage where they kept their valuable financial vehicle. This perspective reframes real estate's role entirely. Instead of being the primary source of riches, it becomes a secondary tool for wealth preservation and diversification. They are advised to diversify. A significant portion of that money often goes into real estate, perhaps a primary residence, a vacation home, a few rental properties. So while it is true that this millionaire now owns real estate, it is not what made them a millionaire. The business did. The real estate is simply part of a smart strategy to protect and grow what they already earned. Therefore, a more accurate statement might be 90% of millionaires invest in real estate. This small change in wording makes a world of difference. It shifts the focus from creation to strategy. The lesson is not that buying a house will automatically make you a millionaire. The real lesson from the wealthy is that once you have generated capital, owning tangible assets like real estate is a prudent way to manage it. This understanding is crucial for anyone starting their financial journey. It cautions against taking on excessive debt to buy property with the magical expectation of becoming rich, and instead encourages focusing on building income first. The rising tide, how global property values lifted all boats. Regardless of how millionaires initially make their money, there is no denying the tremendous impact of rising property values on household wealth across the globe. Over the past 2 decades, the world has witnessed an unprecedented real estate boom. Fueled by low interest rates, population growth, and increasing urbanization, this sustained appreciation has acted like a powerful rising tide, lifting the financial boats of millions of homeowners. For many families, the single largest asset they own is their home, and as its value climbed year after year, so did their net worth on paper. The numbers are staggering. According to reports from financial institutions like Credit Suisse, the number of individuals with a net worth between $1 million and $5 million has more than quadrupled globally since the year 2000. While many factors contributed to this growth, experts consistently point to the appreciation of non-financial assets, with real estate being the most significant component. Think about it in simple terms. A family that bought a home for $250,000 in 2005 might find it valued at $750,000 or more by 2025. Without doing anything other than living in their house and paying their mortgage, their net worth has increased by $500,000. This phenomenon of paper wealth has been a major driver in minting new millionaires. A household's net worth is calculated by taking their total assets, including their home's value, and subtracting their total liabilities, like their mortgage balance. As the home's value skyrockets while the mortgage balance slowly decreases, the net worth figure expands dramatically. For a family that may have had a modest net worth of $100,000, a massive run-up in their local property market could easily push them over the $1 million threshold. And coastal areas, where land is scarce and demand is high. This surge in property values has fundamentally reshaped the balance sheets of ordinary families. It has allowed them to access wealth that was previously unimaginable. This newfound equity can be tapped through home equity loans or refinancing, providing capital for other investments, funding a child's education, or starting a business. In this sense, the rising value of a primary residence has acted as a forced savings plan on steroids. While the wealth is on paper until the property is sold, its psychological and financial impact is very real, giving millions of homeowners the financial security and status of being a millionaire. To see this dynamic in action, we need only look to Australia. The country serves as a perfect case study for how a prolonged property boom can create a nation of paper millionaires. For decades, Australian cities like Sydney and Melbourne, this has led to a situation where a significant portion of the population, particularly older generations who bought homes long ago, now find themselves with a net worth exceeding $1 million Australian dollars. This wealth, however, is overwhelmingly concentrated in the value of their family home. Studies from Australian research firms and universities repeatedly show that for the majority of millionaire households in the country, their property is the hero of their financial story. Their wealth was not built on a diverse portfolio of stocks and bonds, but on the simple fact that they owned a home in a neighborhood that became incredibly desirable over time. A modest bungalow in a quiet suburb of Sydney, purchased for the equivalent of $50,000 in the 1980s, could easily be worth over $2 million today. This dramatic appreciation single-handedly catapulted the owners into the millionaire category, defining their financial status. However, this phenomenon has created a significant social and economic paradox known as being house rich, cash poor. Many of these property millionaires live on modest retirement incomes. They have a multi-million-dollar asset. They may struggle to pay for rising utility bills, healthcare costs, or even basic home maintenance. Their wealth is illiquid. It is trapped within the four walls of their home. To access it, they would have to sell the family home, which is often an emotionally difficult decision, or take on debt against their property, which can be risky in retirement. The Australian example provides a crucial lesson. It demonstrates the immense power of real estate appreciation to build wealth on paper, confirming that property can indeed make you a millionaire. But it also highlights the potential fragility and limitations of this type of wealth. Without sufficient cash flow or liquid assets, being a property millionaire does not always translate to a luxurious or stress-free lifestyle. It underscores the importance of a balanced financial plan, where the wealth in your home is complemented by and more easily accessible investments. It shows that net worth is one thing, but financial freedom is another entirely, So, how exactly does real estate work to build wealth? It is not magic. It is a process that rests on four fundamental pillars. Visual four icons: leverage, appreciation, rental income, reinvestment. The first and most powerful pillar is leverage. Real estate is one of the few investments where you can borrow a large sum of money from a bank to purchase an asset. When you buy a $500,000 property with a 20% down payment of $100,000, you are controlling a $500,000 asset with only 1/5 of the cash. This is leverage. This use of leverage dramatically magnifies your returns. If that $500,000 property increases in value by just 5% in 1 year, it is now worth $525,000. That is a $25,000 gain. However, you only invested $100,000 of your own money. This means your return on investment is a stunning 25%. $25,000 gain divided by $100,000 investment, not just 5%. This amplification effect is what allows real estate investors to build wealth far more quickly than if they were investing only with their own cash. Of course, leverage is a double-edged sword and can amplify losses as well. But when used wisely in a rising market, it is an incredibly powerful tool for wealth acceleration. Over the long term, the value of well-located real estate tends to increase. Population growth, job creation, inflation. As cities expand and more people need places to live, the land becomes more scarce and therefore more valuable. This steady, long-term growth is how most property owners build equity. It is not a get-rich-quick scheme. It is a get-rich-slowly plan. The small annual gains compound over decades, eventually turning a modest initial investment into a substantial asset. This patient growth is the bedrock of real estate wealth. The third pillar is rental income. If you own an investment property, the rent paid by your tenants provides a steady stream of cash flow. Mortgage, property taxes, insurance, maintenance costs. The goal is for the property to pay for itself. Over time, as you pay down the mortgage and as rents increase, this cash flow turns into pure profit. This passive income can supplement your regular salary, fund your retirement, or be saved for future investments. As you build equity and cash flow from one property, you can use that wealth to acquire another, You can pull equity out through a refinance to use as a down payment on your next property, repeating the cycle and growing a portfolio that generates even more wealth. Yeah, that's the blueprint. While the path to riches through real estate may seem straightforward, it is littered with potential pitfalls and hidden dangers. Believing that property values only go up is a costly mistake. The most significant risk is a market downturn. The 2008 global financial crisis was a brutal reminder that real estate markets can and do crash. Homeowners who bought at the peak of the market found themselves underwater, owing more on their mortgage than their home was worth. When leverage works in reverse, it can wipe out an investor's entire initial capital and more, leading to devastating financial losses and foreclosure. Beyond market crashes, the ongoing costs of ownership are a constant drain on profitability that many novice investors underestimate. A property is not a static asset that you can just buy and forget. It requires constant upkeep. Roofs leak. Plumbing fails. These maintenance and repair costs can be substantial and unpredictable. Property taxes, homeowners insurance, property management fees. These costs eat into your rental income and reduce your overall return. Failing to budget for them can quickly turn a seemingly profitable investment into a money pit that bleeds you dry. Another major risk is low liquidity. Unlike stocks or bonds, which can be sold in seconds with the click of a button, real estate is a highly illiquid asset. Selling a property can take months or even longer in a slow market. You cannot quickly convert your home into cash if you face a sudden financial emergency. This lack of liquidity is what leads to the house-rich, cash-poor problem. Your net worth might be high, but if all your wealth is tied up in a property you cannot easily sell, you lack the financial flexibility to handle life's unexpected challenges. This can create immense stress and force you to sell at an inopportune time. Finally, the very tool that makes real estate so powerful, leverage, is also what makes it so dangerous. Taking on too much debt makes you vulnerable. If you lose your job or if your rental property sits vacant for a few months, you still have to make that mortgage payment. Failure to do so can result in default and the loss of your property. The pressure of servicing large debts can be immense. Smart investors understand these risks. Use leverage cautiously. Maintain significant cash reserves for emergencies and repairs. Focus on the long-term fundamentals rather than trying to make a quick buck in a hot market. So, did real estate make today's millionaires? The answer is a nuanced yes, but not in the way the popular myths suggest. Real estate has undeniably been a major component in the wealth of most millionaires, and a primary driver for lifting many households across that seven-figure line, especially in recent decades of soaring property values. Long-term appreciation, rental income, is a proven formula for building substantial net worth. For many, their home became an accidental investment that paid off handsomely, turning them into millionaires without them even realizing it was happening. However, the evidence strongly suggests that for the ultra-wealthy, and for many self-made millionaires, real estate was not the spark that lit the fire. Instead, it was the fuel they added to a fire that was already burning. They first created significant capital, now through business, a high-paying career, or savvy investments in other areas. Then they strategically deployed that capital into real estate to preserve their wealth and benefit from long-term, leveraged growth. Real estate was a tool for amplification, not the primary act of creation. It was a crucial part of their wealth strategy, but it was not the starting point. This distinction is the most important takeaway for anyone aspiring to build wealth. Viewing real estate as a magic wand that automatically turns you into a millionaire is a dangerous oversimplification. It can lead to taking on too much risk, over-leveraging, and failing to focus on increasing your income. The real lesson from the wealthy is not just to buy property, but to build a strong financial foundation first. Increase your earning power, save diligently, and then use real estate as a powerful, tangible asset to accelerate your journey toward financial independence. In summary, property is not a get-rich-quick scheme, but a cornerstone of many get-rich-slowly plans. But it requires patience, diligence, and a clear understanding of the risks involved. The truth is not that real estate is the only path to becoming a millionaire, but that it is an incredibly effective component of almost any successful long-term financial plan. It is a powerful tool, but like any tool, its effectiveness depends entirely on the skill and knowledge of the person using it. Acknowledge its power, but respect its dangers. Understanding the principles of real estate investing is one thing, applying them is another. The journey can seem intimidating, but it begins with a single, manageable step. Your first move should not be to call a real estate agent or apply for a mortgage. Your first step is education. You must arm yourself with knowledge before you commit your capital. The world of real estate is local. What works in one city may fail in another. Read local business journals. Follow real estate news. Study neighborhood trends. Understand where the jobs are. Understand where the population is growing. Understand where infrastructure is being built. Once you have a grasp of the local landscape, get your financial house in order. This is the foundation of successful investing. Create a detailed budget. Reduce or eliminate high-interest debt. Build a solid credit score. Establish an emergency fund to cover 3 to 6 months of expenses. This fund is non-negotiable. It is your safety net against forced sales after a job loss or major expense. After that, seek professional guidance. No book replaces tailored advice for your situation. Talk to 2 types of professionals. Consult a fee-only financial advisor. Speak with a seasoned mortgage broker. Talk to a reputable real estate agent who specializes in your property type. This step-by-step approach reduces risk. It turns you from dreamer to informed investor. Start small and think long-term. Consider a small condo. Consider a duplex. Live in one unit and rent the other. House hacking. Or consider your primary residence as a start. Make your first purchase conservative and learn from it. Real estate rewards patience and persistence. But as with any story that sounds too good to be true, it is crucial to look beyond the headlines. We must separate the hard facts from the pervasive myths to understand if real estate is truly the ultimate millionaire maker it is often claimed to be. The core idea is that an asset you can see and touch provides a sense of security that digital assets cannot. While stocks can vanish overnight and currencies can devalue, land is finite. This fundamental truth gives real estate its enduring appeal.